Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. Today, we'll be talking about cash flow statement. And if you've been following my episode, you know that this belongs to the top 3 statements that I mentioned in importance: the balance sheet, the income statement, and the cash flow statement. But some people, you might find, may argue that the cash flow is probably one of the most important ones. And why is this? Basically because the cash flow will describe the changes in the cash balances in a company. So it will explain the sources and the uses of cash and how is the money moving inside the company. Usually, you will find that cash flow statements will vary between the life cycle of a company. So if you have a company that just started and it's growing, it will have a big cash flow on the financing part, a lower one in the operating one as it still hasn't started producing as much, and a low one in investing because it doesn't have any extra money to start investing. As soon as a company starts to grow, you will see that it will have a higher cash flow in the financing part as well. Still, it has lots of financing and it's trying to pay it out, but the operating cash flow will probably reach a point where it's breaking even. Operations will start being profitable, even though investing cash flow may still be negative because you might still not find a company that's investing a lot. If you find a company in maturity, you will have the financing that's breaking even. A company doesn't have to finance itself anymore. It has a positive cash flow in operations, and it has a growing cash flow in investing. And finally, a company in maturity would have a negative cash flow in financing, a positive one in operating, and a positive one in investing. So why am I putting all of the stages of a company in these 3 terms: financing, operating, and investing? If you recall from my first episode explaining the financial statements, you'll remember that cash flows are always divided into 3 this big parts. Financing, it's going to be all the cash that's going to be related to how the operations in the company are financed. Operating, it's going to be, as the name says it, related to all of the operations. And then investing, it's going to be how the money is used for investing. So which things might enter each part of the cash flow? Well, for operating, which is how you usually start cash flow, of course you'll have money from the inventory and from the core operations, which might include the labor or the rent. But if we had to generalize, let's say, or get a rule of thumb, it would usually be everything that's related to the current assets and the current liabilities, because this is going to be money going in and out, usually for operations. Now, if we look at the second category, which is investing, we might find, of course, the PPE, property, plant, and equipment, and the buying or selling of other people's shares or debts. Basically, all of the cash flow from investing will come from the non-current assets. And now, if we have to decide the cash flow from financing, it won't be in the assets column. It's going to be from the long-term liabilities and equity, because this is going to be all the money that's used for financing the operations and the investments as well. So it will include the share issuance, for example, the dividends, or the borrowing of money, which might include interest or debt. For calculating the cash flow statement, there are 2 methods. There's the direct method and there's the indirect method. The direct method, as the name says it, it's very clear. It's a breakdown of all the sources and uses from operating cash flows. And here you'll have the cash received from customers, the cash paid to suppliers, the cash paid to employees, the cash also paid for operating costs, the cash paid for the interest expense, and the cash paid for the income taxes. So here, it's going to be very direct, very straightforward, and you'll be able to find and clearly see everything. Now, if you have to estimate all of this cash amounts, I'm going to give you the formulas for each. For the cash received from customers, you'll get that by taking the revenues minus the increase in accounts receivable, and then plus the increase in the deferred revenues, because this accounts receivable and deferred revenues are going to be affecting your cash. Now, if you want to calculate the cash paid to suppliers, you would get the cost of goods sold plus the increase in the inventory, and then minus the increase in accounts payable. Third element would be the cash paid to employees. And this is going to take the wages expense, and then you're going to subtract from that the increase in the wages payable. Now, when we're considering the cash paid for other operating costs, this will take the other operating expenses and it will increase the prepaids minus the increase in accruals. The last two categories are going to be cash paid for interest and cash paid for income taxes. So the cash paid for interest will be calculated by taking the interest expense and then decreasing the increase in interest payable. And then lastly, the cash paid for income taxes will be the income tax expense minus the increase in income tax payable. So if you get this, usually you'll get to the cash from operations, which is going to be part of this cash flow. Usually what we're looking at here, though, it's the operating cash flow, the CFO. But there's another method that's called the indirect method. And this indirect method, even though it sounds less intuitive, it's the one that companies are going to always report because they're forced to do that, basically. In the indirect method, always companies must start from their net income, which is what we get from the income statement. The sum of all of it at the end would be the net income, and you have to reconcile it to the cash flow of operations. Basically, in simpler terms, we're trying to explain why don't we have all this money from the net income in our pockets? Why don't we have it in cash? Here, this explanation of the difference between the two values will be done by starting with the net income, and we're going to add or subtract things that weren't really cash movements, but that they did impact our net income, such as depreciation and amortization. Of course, we know from my last episodes that depreciation is the value that you're taking away from a machinery or a thing that you're using, a PPE. But the fact that my machine or my computer or things that like that are getting old, it's not really taking money out of my pocket. The depreciation, it's just an adjustment I'm making. But so, since it's not taking money out of my pocket, we should add that value up to the net income. Because it didn't really take it out, we should add it back up. Same with the non-cash losses. But then, we may have the opposite. We may have the non-cash gains. The non-cash gains are going to be those that we added, but they didn't really give us a thing in the cash statements or the cash flow, so we're going to subtract them in this case. We're also going to subtract the changes in the current operating assets, and lastly, we're going to add up the change in the current operating liabilities. Basically, from all of this, we should have reached the cash flow from operations. And there will be some things that will explain the difference between this net income and the cash flow. All of them should be explained here in the indirect method. The indirect method will include reconciliations in your statements because you always have to consider your cash column, your non-cash assets, which are usually the ones affected, and your equity. If you didn't have an effect on cash, but you did have an equity, you have to balance it out. Or if in the opposite, you did have an effect in cash, but you didn't have an effect in equity, you'll have to balance it out. Always, you have to explain why these two values were different and what can you do to explain this difference between those two.